Welcome back, it's JWalter here, and here's your latest housing market update. I actually want to provide an explanation about why mortgage rates have been increasing so much. So if you missed my previous video, the average 30-year fixed rate mortgage in the US reached 5.25%, which is just mind-blowing, the highest rates we've seen since 2009. In addition, mortgage rates have increased approximately 1% in the last 30 days alone, which is just absolutely insane. So I just kind of want to provide some context about why mortgage rates have been increasing, and I found a very good article on the Mortgage News Daily's website. That's the Mortgage News Daily's website that was actually just published today, which is April 11th. So with that said, let's go ahead and dive right into the video. If you get any value out of this video, then please hit the like button. Also consider subscribing as well. Also check out that link below if you want a real estate agent referral in your neck of the woods. So with that said, let's dive right in. So this is according to the Mortgage News Daily. Of course, they're reporting that the average rates have spiked to 5.25% for the 30-year rate mortgage, the highest since 2009. Pretty remarkable. It says in this article here, the last few days of March offered some hope that 2022's massive rate spike might be slowing down. The first few days of April crushed those hopes, and things have only gotten worse since then. After breaking above 5% by the end of last week, Monday morning brought the average 30-year fixed rate up to 5.25%, a level not seen since 2009. Pretty crazy. So here is why mortgage rates have been increasing. There's a lot of context here, so let me just kind of dive in right here. And by the way, this is the biggest and fastest jump in mortgage rates since at least 1994. This is a huge deal because a lot of people looking to buy a house right now, if they're pre-approved for a maximum budget of, let's say, $400,000 1 month ago, a 1% increase in mortgage rates causes a 10% decrease in buyers' purchasing power. So if the maximum amount that you're pre-approved for was $400,000 1 month ago, then now you're suddenly pre-approved for $40,000 less than your previous pre-qualification. So if your maximum you were pre-approved for was $400,000, now it's only going to be $360,000 because mortgage rates have been increasing greatly. So if you are looking to buy a house right now, and you already have been pre-approved, then definitely reach out to your loan officer as soon as possible to see how the increase in mortgage rates may be affecting you, because chances are you're pre-approved for less, and also your housing payment is also going to be more because mortgage rates have been spiking. So with that said, let's go ahead and dive right into the rest of this video here. So according to the Mortgage News Daily, as for the why mortgage rates have been increasing so much, they say it's fairly straightforward. The Federal Reserve, aka the Fed, is best known for setting the federal funds rate, which dictates the cost of the shortest term financing. That is the short-term rate that banks charge each other for overnight lending. So that's the federal funds rate, not to be confused with mortgage rates. In any case, the Fed raises and lowers that rate, the federal funds rate, to try to persuade inflation and employment to remain in certain ranges. So if you guys all know, the long-term range or target range that the Fed wants the inflation to be at is in the range of 2 to 2.5%. Obviously, right now we're at 7.6%, much higher than their target range, and that's why they're going to be increasing the federal funds rate to control inflation. In cases where the rate is cut to zero and the Fed thinks more needs to be done, they buy bonds, which are US Treasuries and mortgage-backed securities. Buying bonds creates excess demand in the bond market, which in turn pushes longer terms lower and causes mortgage rates to lower as well. It basically is a way for the Fed to influence both short-term and long-term rates. So it goes on to say, at the start of this pandemic, which was basically in March 2020, financial markets were in chaos, and the Fed stepped in to cut rates to 0% for the federal funds rate and buy bonds at a faster pace than ever before. And you can see that here on Fed's website here. So as of January 2022, the federal funds rate was 1.55%. It was basically the same in February 2020, but look what happened in March. March, it decreased to 0.65%. Then in April, it dropped to basically 0%. So basically in the matter of 2 months, we went from 1.6%, 1.5% to basically down to 0%. And that caused mortgage rates to decrease greatly. And of course, because they started buying mortgage-backed securities greatly as well, that caused mortgage rates to decrease. So have a look at this. Basically in March 2020, at the March 19th, 2020, according to Freddie Mac, the average 30-year fixed rate mortgage in the US was 3.65%. But because the Fed dropped the federal funds rate and also they started buying mortgage-backed securities in big numbers, that caused the rate of mortgage rates to decrease greatly. So again, back in March at 3.65%, it dropped to all-time record lows in January 2021 to 2.65% for the average 30-year fixed-rate mortgage in the US. In any case, it goes on to say the following: rather than dial back those bond purchases when markets began to settle, the Fed concluded that it should continue providing as much monetary stimulus as possible in light of COVID's impact on the labor market. They justified this with the assumption, keywords there, that COVID-driven inflation would subside as the pandemic subsided. Obviously, that did not happen. They were saying that the inflation was going to be transitory, but we're seeing this is going to be a long-term trend and not a short-term trend. And it said, obviously, inflation did not subside. As the 2022 approached, we suddenly found ourselves staring down the barrel of the biggest inflation numbers and the tightest labor market in decades. Meanwhile, the Fed still had its federal funds rate at near or 0% and was still buying more than $100 billion in bonds each month. So have a look at this, because in 2021, we were around 3%. So during this time, the Fed was buying mortgage-backed securities in big numbers, and they still maintained the federal funds rate at or near 0%. They also said that change was slow to come at first from the Federal Reserve. In September 2021, the Fed began winding down new bond purchases. Again, those are mortgage-backed securities and Treasury bonds, a process it needed to complete before hiking rates. So in other words, they needed to wind down their purchases of mortgage-backed securities and Treasury bonds before they increased the federal funds rate. A few months later, as inflation continued to surge and the labor market grew tighter, the Fed began accelerating its exit of these policies. So in other words, they accelerated their taper of their purchases of mortgage-backed securities and Treasury bonds. So again, in September 2021, they announced they're going to be winding down their purchases of mortgage-backed securities, and then they began to accelerate that taper. And this rapid rethink and rapid removal of bond buying demand on the part of the Fed is a key ingredient in the rate spike seen so far in 2022. So again, the markets were predicting or were forecasting the Fed to wind down their purchases of bonds, but they started to accelerate them. That's one reason why mortgage rates have been spiking. Yet another reason why mortgage rates have been increasing so greatly more recently, though, is because in a prepared speech on Tuesday morning, Fed Vice Chair Brainard, who's normally one of the most rate-friendly Fed speakers, joined a chorus of more hawkish Fed members who've been talking it up about the possibility of extremely large reductions in the Fed bond buying program. This is referred to as normalization. And the market was, again, very surprised to hear this, because Brainard is less hawkish than the other members of the Fed. To make matters worse for mortgage rates, the next day they released the minutes from their most recent Fed meeting that occurred 3 weeks prior. In that report, they basically had a bombshell. It says, in a nutshell, the minutes, again, from the meeting from 3 weeks ago, laid out an explicit roadmap for normalization. Again, normalization is a reduction in the bond buying program. Whereas the Fed rolled out 2017's normalization process with only a $4 billion per month hit to mortgage-backed security purchases, the plan for 2022 calls for phase one to start at a staggering $35 billion per month versus $4 billion in 2017. They said they knew it would be bigger and faster, but not quite this big or fast. And here's a graphic depiction about how the U.S. Treasury yield, or the 10-year U.S. Treasury yield, has fluctuated because of all these events. So again, Brainard's comments caused the 10-year Treasury to spike greatly from around 2.48% to 2.56%. Then again, we had the release of the Fed minutes from the previous Fed meeting from 3 weeks ago. That caused the 10-year U.S. Treasury yield to increase greatly on April 7th and April 8th, up to 2.72% approximately. And again, as I mentioned on the channel all the time, the yield on the 10-year U.S. Treasury note is tied more loosely to mortgage rates than anything else. It says mortgage rates care about 10-year yields because 10-year yields speak to trends in longer-term rates in general. Have a look at this following chart here, because this is the correlation between mortgage rates for the 30-year fixed-rate mortgage and also the yield on the 10-year U.S. Treasury note. As you can see here, since 2023, it's not perfect, but every time the yield increases, so do mortgage rates in general. And then when the yield decreases, so does mortgage rates as well. And you can see that for basically every single year here, the 10-year US Treasury yield follows closely with the fluctuation in mortgage rates. As you can see here, basically since mid-2021, rates were basically at all-time record lows, but look what the 10-year US Treasury yield actually shot up greatly, and also mortgage rates increased greatly as well. From January 2021 at approximately 2.7%, now we're at 5.25%. It says in this article here that we're waiting for several key developments, and that of course would be inflation data to show signs of shifting. It goes on to say in this report here, they're trying to figure out what the Fed is going to be doing in their next meeting, which is in May. They're probably going to be increasing the federal funds rate by 0.5%, which is 50 basis points. That's what the street is forecasting right now. They're also likely to enact the normalization plan laid out in last week's minutes. It says if that's the extent of the damage, then the market will finally be on the same page with the Fed, barring any additional accelerations in the coming weeks. It says that means the rate hike and the big reduction in the bond buying program could actually be a good thing for longer term rates. It says the longer term rates always do their best to account for future possibilities. In several past occasions, we've actually seen mortgage rates move lower while the Fed policy was tight or tightening. In other words, on past occasions when the Fed increased the federal funds rate, that caused mortgage rates to actually decrease. So take a look at this. As you can see here, when the Fed started increasing the federal funds rate back in 2015, during a short period of time here, mortgage rates actually decreased because this orange line here is the average 30-year fixed rate mortgage, the rate on that, actually decreased through mid-2016. So here's the key question. How well have long-term rates priced in the future this time? It's only been the unexpected, that's a key word there, unexpected. It's only been the unexpected changes in the outlook that have caused so much extra upward momentum in mortgage rates. Once that outlook stabilizes, rates will probably already be coming back down. Unfortunately, there's no telling if that's the sort of thing that will happen in the next few weeks or few months, or what will happen throughout the year. So hopefully that gives you some clarification about what's been going on with mortgage rates. So comment below with your biggest takeaways. In my personal opinion, the biggest takeaway for me is this: unexpected changes in the outlook causes extra upward momentum in rates. So in other words, when there's big unexpected changes, that causes a lot of volatility in mortgage rates. If you got any value out of this video whatsoever, then please hit the like button. I greatly appreciate that. Also consider subscribing if you haven't done so already. Hope you have an awesome day. Look forward to seeing you on the next video.